Thursday, September 2nd, 2021, Maneco 64, home of alternative economics and contrarian views. Today we're going to talk about bubbles and how you clean up after a bubble and whether the powers that be, the monetary powers that be, the fiscal powers that be, those are governments of course, will be able to clean up after this everything bubble. Alan Greenspan has spoken a lot about bubbles. He's spoken about how central bankers should focus on cleaning up after the bubble, that they shouldn't be worried about not allowing bubbles to evolve. And a lot of times, of course, they can't stop it. But I would say a lot of these bubbles that we've had in the last 30 years are because of the central bankers, because they've run a monetary policy of artificial low interest rates. They've pumped up their balance sheets, i.e. with QE. And I think they've created a monster now. There's an interesting article here from the Harvard Business Review from 2014. And it's about Alan Greenspan, and it's entitled What Alan Greenspan Has Learned Since 2008. Alan Greenspan, of course, he was chairman of the Federal Reserve up until 2006, just before the great financial crisis. In this article, he talks about how the dot-com bubble, for example, had very little impact on GDP, how the 87 crash also had very little impact, how the 94, 95 collapse of the bond market also had very little impact, and how they're able to clean up those bubbles. But I'm afraid these bubbles are getting bigger and bigger. I think the everything bubble is not just about a sector of the economy, it's the whole economy. And why have central bankers allowed this bubble to grow? Well, I think it's because they've made so many mistakes, starting with Greenspan, of creating the Greenspan put. He first did that in 1987, and it's gotten worse and worse. It's made investors, speculators misbehave. It's what William Silber talks about in his book, The Power of Nothing to Lose. And I'm going to be speaking to William Silber next week about this book and other things like inflation. So yes, Wall Street, City of London, hedge funds, speculators, they've realized that whatever they do, as long as they do it really big, as long as they do it so that if there is a problem, the whole economy will be in peril, they'll be saved. But I'm afraid it's getting too big now, and tapering tapering is the way the central bankers are trying to unwind the biggest bubble ever, I would say, in recorded history that we know of. And yesterday there was a story here about the ECB. In the FT, it says bond investors positioned for pullback in ECB support. Central bank expected to hint at lighter support for bond market, but with big safety nets. So what is it, Madame Lagarde? Are you going to taper or not? So it just goes to show that it's an impossibility. Why they're talking about this now? Well, because we've had really high inflation numbers in Europe, numbers that we haven't seen in decades. So investors probably want, the ECB is trying to placate investors, but it's going to be very hard. Same thing with the Fed. We're hearing, of course, a lot about tapering, but aside from the stock market bubble that we have, and we're going to look at that in a minute, we've got a bond market bubble. I mean, when I started out in the financial markets back in the late 80s, and I still remember the yields that we had. We had 3-month money for dollars at over 7%. We had Italian interest rates running at double digits. We had the French rates were probably more like 7 or 8% or 6%, the long-term rates. German ones were around 5, the Swiss around 4, maybe a little more. And the economies ran pretty well. There wasn't the disaster that we have now in the economies, despite the high rates. And just wanted to show you how crazy things are now with all the debt that we have. But that's the problem as well. The debt that they've taken on, the debt that the governments have created, the debt that corporations and everyone has taken makes it imperative that the central bankers keep interest rates low. I mean, when you look at the Italian yield curve, if you had asked me 15, 20 years ago that Italian yields would be negative up until the 5-year maturity, I'd say you'd be crazy, but that's where we are right now. If you told me that the French yields would be negative up until the 10-year maturity, same thing, and even the German yields, that they'd be negative until the 25-year maturity, I would say that, yeah, that's crazy. It's impossible. I remember there was the, well, there's still that contract. It's the Euribor contract or Euromark at the time before the euro. These are futures contracts, like we had the euro dollar as well. That's on the dollar. It's on the international euro dollar market where you lend dollars outside of the US. This contract, for example, if it's trading at 95, it means that let's say the 3-month euro-dollar rate is 5%. And I remember, though, back in 2010, 2011, people were talking, well, I think we could go over 100, and people would say, you're crazy. If we go over 100, it means rates are going to be negative. And these are for short-term rates. But now you have almost the whole yield curve for the major European countries negative. Yes, the US hasn't gone negative, but it's still very low. So let's have a look at why. I think we are in the biggest bubble ever. First of all, we'll look at the stock market, because this is not just a stock market bubble, as I said. It's a bond bubble, and the bond bubble is, without a bond bubble, we wouldn't have the housing bubble as well. We wouldn't have all the other bubbles, the credit boom that we have. So I took this screenshot from Twitter. Someone called BP Rising tweeted this and said, market cap to GDP is the top indicator Buffett, means Warren Buffett, uses to gauge an overvalued market. It's now a mind-blowing 205% of GDP. This is far worse than the insane 2000 bubble. It was less than 150%. So look at it, the 1929 bubble was 1.22% or 122% of GDP. Now we're almost, we're at 205% of GDP. And that's just the stock market. And for the bonds, the interest rates show you that it's a bubble because negative rates means the price of bonds have gone up. And that's why people have stayed in the bond market, because central bankers have done something they call forward guidance, which is basically telling investors to keep buying bonds because they're going to come and buy it from them, and that will make the price go higher. So they've created a Ponzi scheme in the bond market. And I guess they can keep this Ponzi going forever because the central banks have the legal authority to keep creating these reserves. But I think this shows how there is a bond bubble in the US and in the euro area. Euro area are the countries in Europe that use the euro through the ECB. So I took another screenshot from Twitter. This is from Sven Henrik, and he says, the ECB and Fed have added 7 trillion to their combined balance sheets in just over a year and a half. And this is really interesting. Between 2008 and 2017, in those 10 years, they had added 6.5 trillion. This means they have bought more assets in 17 months than they did in the 10 years following the great financial crisis. So yes, as I said, these central banks, they can keep doing this forever. They can keep running this Ponzi forever. The only problem is that eventually people are going to wake up. Of course, I've been awake about this Ponzi for many years, if not decades, but the majority of people haven't yet. And when they do, that's when you get the currency collapse. That's when people will want to exchange their currency for anything but paper or paper assets. They will want real things, tangible assets. That's when you're going to get your crack up boom. And I think the central bankers are concerned about that now. And that's why they're talking about tapering. The only problem is that tapering will be very short-lived if they try it in a significant way, and then they'll have to come back with even more Ponzi finance. So that's why I'm willing to wait. I'd rather be very early than sorry, and that's why I try to get out as much as possible out of this system. Yes, I do have exposure to this system, and a lot of people are totally exposed to it. And it's not for me to tell you how to get out of it, partially or totally, but I'm just here to tell you that things are not normal, and you need to realize that. So with that, let's look at where the markets are this morning. It's 8:39 a.m. London time. We've got spot gold at 1814. It's up under $1. The range has been 1816 to 1810. Yesterday, we saw silver outperform gold, even though silver is still relatively low, I would say. And I could sense that if they hadn't kept gold down yesterday, gold and silver would have gone a lot higher. That's what they do a lot of times. When one of the precious metals is doing really well and they can't keep it down, they'll try to bash the other one. I've been following this for almost 20 years because when I bought my first gold coins back in '02, I was still working in the city. I didn't trade precious metals. I was a bond broker, but I started following it very closely, and I noticed these patterns. And I quickly learned that there were the bullion banks, which were the major banks, playing around with the metals. That's what they do. Anyway, yesterday we had the ADP employment data. It was half the expectation. So I think a month ago, ADP was really weak as well. But then 2 days later, on the Friday, we got the non-farm payroll, and it was a better number. And that's when they bashed gold quite hard. So yes, yesterday's data not pointing to a good labor market, but we'll still have to wait and see what they come out with tomorrow with the non-farm payroll. So silver right now is at 24.15, up 2 cents. Range has been 24.23 to 24.09. So yeah, we're still really far away from where we need to be in terms of price. But I have a feeling once we start moving, it's going to be quite swift. I've seen silver move $1 to $2 a day, even when it was in the teens back in like '05 or '06. Anyway, What about the stock market? It's not a bubble, right? The Dow futures up 18, the NASDAQ futures up 14 points, the S&P 500 is up 4 points. The FTSE is up 6 points at 7150. Yeah, the FTSE actually, I would say it's not really a bubble. The bubble here in the UK is more in housing. And why do I say that? Well, because the FTSE was trading at 7,000, almost 7,000 back in 2000. And here we are, over 20 years later, and we're only 150 points higher. What about the currencies this morning? The pound is up just under 0.2% at 137.90. The euro is at 118.50. That's up slightly. The dollar is unchanged versus the yen at 110.02. The dollar is up slightly versus the yuan at 645.26. Now to the Antipodean currencies and the Canadian dollar. Aussie dollar is up 0.2% at 73.82, and the dollar is down 0.2 versus the Canadian dollar at 125.92. Kiwi dollar is up 0.1% at 70.77. WTI crude is unchanged at 68.50. High-grade copper up 0.5% at 429.44. The 10-year yield is at 1.3%. I think that's what the Fed wants. The 10-year yield fixed. Maybe they're doing yield curve control without people knowing already. They're not letting yields go above, let's say, 1 3/8, which is 1.37. Maybe that's their new thing. Before I finish, just wanted to talk about a little bit. I haven't really looked too much into it, but there's talk of a huge, I think, construction or property company in China. The exposure, the debt exposure is like in the trillions. It's called Evergrande, I think, that you could have a bubble bursting in China. We'll have to see. I mean, China is an important country now, so maybe it's not just in the West that we have a huge bubble. Maybe China has a bad bubble too. Who knows? And who knows whether their government can keep it from bursting, because we know it's a much more centralized economy there, even though our economies, we're told that they're free market economies, but we're not, because I saw yesterday that the UK government, which is supposed to be a conservative government, is creating a bank, and it's hired a former CEO of HSBC to run it. So yes, I don't think we're that free here. So yeah, the Chinese government might try to stop trouble happening in their system, but we're doing the same thing. We're doing it through the Federal Reserve, with the Treasury. We're doing it with the Bank of England and the UK Treasury, and the ECB is doing the same thing. So to say that they're communist and there's no free market there, there's intervention, is really the pot calling the kettle black, I would say. So if you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. And if you do subscribe, make sure you hit the little notification bell to be notified of all my new videos. I make a video every day, and as I've said before, sometimes twice a day. And you can also follow me on Rumble, Twitter, Facebook, and all these other platforms below here. I wish you all a great day. Take care. Bye.